Understanding the technology that powers the money is essential. Knowing the business drivers that inspire how the money is made is crucial. Bridging the gap between the mind of the technologist and the mind of the business is monumental. That is what TBF is all about. Let's start this never-ending conversation. It's time.
Happy Friday. We are live with another episode of the Tech Behind FinTech. I'm your host, Nnamdi Osuagwu, joining you on another Friday. Let me put the phone on silence. Housekeeping stuff. All right, so housekeeping. We are live from Facebook, LinkedIn. Hold up, let me just stop doing something real quick. Give me a second, guys. Sorry about the delay. All right, cool. All right, back to the housekeeping. We're streaming live from Facebook, LinkedIn, YouTube, Twitch, and we have a separate stream going from Instagram. Like always, we will be covering a bunch of topics today. The main topic of today is unpacking the $10.6 billion price tag for First Republic Bank. This week, the bank went, not this week, but the bank went under. It was purchased by JPMorgan Chase. So we're going to be diving into that deal and the details around it and what led up to this bank collapse and how the FDIC had to step in, regulators and so forth. So it should be an interesting time. Like always, though, before we jump into that, we're going to cover some news topics of the week, and then we will dive into the main topic. My voice is a little bit off this week. It's been a little bit rough, been under the weather this week, but I'm feeling a lot better than I was early in the week. So if you hear a little disruption or a little me sounding a little nasally, that is why. Okay, let's jump into some news topics of the week, and then we'll jump into our main topic. All right, first article: Zimbabwe sets price to sell Go Back digital tokens. So the Zimbabwe central bank plans to sell Go Back digital tokens at $10 US dollars for individuals, $5,000 for a corporation. The Reserve Bank of Zimbabwe on May 4th, the Go Back digital currency tokens will be sold in US dollars and local currency. However, the local currency price will have a 20% margin above the willing buyer, willing seller interbank mid rate. Interested investors can participate in the offer from May 8th, which will close 2 days later. The introduction of digital coins is the latest move by the Southern African nation to support its own local currency, which has weakened 37% against the US dollar on the official market this year. So Zimbabwe has been battling currency instability and high inflation rates for over 10 years. After a period of hyperinflation, the country adopted the US dollar in 2009. In an attempt to revive the struggling economy, the Zimbabwe dollar was reintroduced in 2019. However, in 2022, the government reverted back to using the US dollar to control rising prices. Nigeria introduced its own digital currency, the e-Naira, in 2021, becoming the first African nation to do so. Shout out to Niger. Let's move on to another news article. Going to flow through some of these news articles because you want to get to the main topic today, which is the First Republic topic. So this one, right? So former Uber CSO, Chief Security Officer Joe Sullivan avoids prison time over data cover-up. So everyone was looking at this, a lot of CISOs, a lot of people who are in charge of security for their corporations. He obviously, we talked about this before. This is in the news. It was a cover-up, and the hackers that were eventually caught testified against him, and he was facing prison time. This would have set an interesting precedent, but he did not get prison time. So they're saying Sullivan was charged in 2020 and found guilty by a jury in October 2022. Before the sentencing, prosecutors were hoping for 15 months in prison, while the defense wanted probation, which was the ultimate outcome. So you have probation allowing the former chief security officer to avoid prison time. In addition to probation, Sullivan must perform 200 hours of community service as part of the sentencing. I'm going to breeze through this, but everybody was really interested if he's going to actually do prison time. So, just a summary of what happened. So he worked for Uber between 2015 and 17. He was accused of obstructing an FTC investigation into a data breach suffered by the company in 2014. Excuse me. Sullivan learned of another large breach but decided not to disclose it. A larger incident occurred in 2016 and involved hackers stealing information of more than 50 million Uber users and drivers. The attackers they extorted Uber. They were paid $100,000 through the company's bug bounty program. When they were eventually caught, they pleaded guilty. They were two individuals from Canada and Florida, pleaded guilty in 2019, and they were instrumental in the prosecution's case against the former CSO. He eventually paid them through a bug bounty program, but it was just another level of extortion on their part, and everything came to the fan. All right. Just want to get the outcome of that. Let's move on to the next article. Oh, man. Pressing a lot of buttons right now. Morgan Stanley is reportedly going to lay off 3,000 job cuts by the end of Q2. This follows, this will be a second round of layoffs in the last 6 months after the firm let go of 2% of the staff last December. Their Q1 2023 profit fell compared to last year due to a 32% decline in its mergers advisory arm, a 22% drop in its equity underwriting business. Let's move on to the next one. Always like talking about this company. So Greenwood, we talked about them before in a previous episode, was comparison with Greenwood. Their digital banking platform for Black and Latino individuals and businesses in the U.S. They acquired fellow challenger bank Kinley for an undisclosed sum. Kinley launched in 2020 as a neobank focused on helping Black people in America improve their financial lives through financial education, spend management, and wealth building. The startup, they raised $20 million. Greenwood says the acquisition will help it grow its ecosystem of over 1 million customers while providing Kinley's 300,000 strong customers base with access to Greenwood's financial products. Kinley's CEO will join Greenwood's executive management team as vice president in his new role. He'll be responsible for supporting strategic initiatives of the firm. So Greenwood, let's say their capital raised, they raised $45 million in funding round led by Pendulum, bringing its total capital raise to $88 million to date. Okay, those are the news articles we are covering today. What we want to get into now is just going down the list, like just really understanding the First Republic collapse, number one. So we're going to go through a history, just, read some good articles, put together some bullet points, want to go through that. Then want to go through the JPMorgan acquisition and the current and the deal that they structured in partnership, right, with the FDIC. So let's take it from the beginning. Hold on, let me maximize my screen here. All right, so First Republic Bank, right? Early in the 80s, their First Republic chairman, Jim Herbert, he noticed that a lot of Silicon Valley executives and entrepreneurs wanted jumbo loans, right? At the time, jumbo loans, I mean, it's funny what jumbo loans are now versus then, but they were over $250,000. I think the average loan back then when it started was around $90,000. So obviously now we're talking, millions right now, but at the time, those were considered jumbo loans over that price point. So initially, he rejected the request, but later decided to offer these loans with new rules for borrower liquidity and loan to value ratios. With the research, I think the loan to value ratio had to be was like 50%, right? In the early days, he used to go to open houses across San Francisco, networking with brokers who could pitch the bank's jumbo mortgages to their clients. Over the next couple of decades, First Republic weathered the savings and loans crisis of the mid 80s, went public on the NASDAQ and expanded into wealth management in New York. First Republic became known for handing out interest-only mortgages at low rates to high-income borrowers with exceptional credit scores. Excuse me. The demand for First Republic's loans surged during the pandemic as wealthy buyers sought mortgage deals that allowed them to keep their money in higher return investments. So obviously, as opposed to spending millions and putting all that in the house, they'll get the jumbo loan, and their cash they'll keep basically high returns. So it was very popular. I think in one of the articles I read, Facebook CEO Mark Zuckerberg has one of his mortgages with First Republic. All right, so that's giving you like the basic history of this bank, up until the prior to the collapse, how they started, general background. So now, right, we fast forward, as we know, Silicon Valley Bank, right? They went down. That led to Signature Bank, a bank run on Friday. So on Friday, March 10th, 2023, depositors panicked after SVB, Signature Valley Bank failed because Signature had high amounts of uninsured deposits, which was exposed to the crypto sector. So let's take a moment right there, right, and understand what's happening now. You have people, so to get the limit of insurance on your bank account is what, $250,000. That limit is set by the FDIC. That means if it's FDIC insured. So if you have a bank account and you have under $250,000, and that bank collapsed, you are insured to get your $250,000 back. The problem happens if you have over $250,000. So that money, that overage, you could possibly lose, right? Because now you're uninsured. So, no one ever thinks of the bank collapsing until banks collapse. We did an episode a few weeks ago, excuse me, talking about bank collapsing, the banks going under over the last 20 years, and it's quite a few. So that's what basically happened, right? So, you had a run in the bank, and these banks had high net worth individuals with accounts, and they just start withdrawing their money. So depositors at First Republic Bank pulled more than $100 billion out of the bank during the crisis, as fears that it could be the third bank to fail after the collapse of Silicon Valley Bank and Signature Bank. On March 16th, 11 U.S. regional banks injected $30 billion into First Republic to stabilize the bank, which has seen its stock price drop and was vulnerable due to its large proportion of uninsured deposits. So, even like we just talked about, right? So analysts and bank customers noted that the vast majority of First Republic's deposit, like those in Silicon Valley Bank and Signature, were uninsured above the $250,000 limit, which meant if First Republic were to fail, its depositors would be at risk of not getting all of their money back. Who wants to risk that? So we're seeing the things that are leading up to this collapse, right? Stock price plummeted, and what's interesting to note is, see, we talk about it here. All of those mortgages that they had, those jumbo mortgages, not one was over 90 days past due. So they didn't have problems on that side. It was the amount of withdrawals that came through from the uninsured customers. So the FDIC stepped in, right? Because the regulators, last resort is the regulators taking control of the bank. They don't want to do that. They rather a private sector solution. So in working with different banks tried to put together an auction. So JPMorgan, Citizen Financial Group, Fifth Third Bank Corp, PNC Financial Services Group, excuse me, were bidders for First Republic, with JPMorgan winning the auction due to its whole bank deal, which included assuming all deposits. So let's get into this whole bank deal by JPMorgan. Let me see if there's any comments. Okay, I don't think there's any comments. Cool. So they paid, JPMorgan Chase paid $10.6 billion for First Republic. They took over all $92 billion of First Republic's $103 billion deposits. So they bought most of the assets, which totaled approximately $229 billion, including about $173 billion in loans, $30 billion in securities. So those mortgage loans, most of them were not past due. JPMorgan will repay $25 billion in deposits from 10 large U.S. banks and eliminate $5 billion in its own deposits that were part of the $30 billion rescue deal engineered to stabilize First Republic. Remember, so early in March, there was a bank run. 11 banks got together, deposited $30 billion in First Republic to stop the building. JPMorgan was one of those 11 banks, so they're going to repay the other 10 their $5 billion each, or $25 billion total. As part of the deal, the FDIC will provide loan loss coverage to JPMorgan, with 80% of the coverage for single-family residential mortgages over 7 years, and 80% coverage for 5 years on the commercial loans, including real estate. So what does that mean? So remember those jumbo mortgages we talked about? As part of the deal structure, even though JPMorgan Chase is buying this for the $10.6 billion, the FDIC is saying, listen, if there is a loan default, we'll cover up to 80% for the single family jumbo mortgages. That means if, let's say there is hypothetically $1 million home, or probably jumbo, probably talking about, $10 million home, right? In the next 7 years, if one of those mortgages defaults, that means the person who, the owner, stops paying, it goes into foreclosure, the FDIC will step in and pay JPMorgan $8 billion of that $10 billion, or 80%, depending on how much the money borrowed out of the $10 million. So that's but we just talked about it, right? Minimum risk in this case, because zero of the loans were, at least the jumbo mortgages loans were, and zero in 90 days past due. So that's a minimum risk, it seems like, in this particular portfolio. And they'll do similar over 5 years on the commercial loans, including real estate. So that's really the details of this particular deal for First Republic. Excuse me. Before we go on, let's give a shout out to our sponsors. Today's episode is sponsored by Strategic Generation, cybersecurity firm offering SOC 2 services and pen testing services. You can find them at strategicgeneration.com. Also, want to say we're going to start, in our support of the FinTech community, we're going to start giving some free shout outs to a couple of FinTechs that we are in network with. So we're going to start doing that next week's episode. We sent some messages out to some folks to fill out a form, and if they want their company to be profiled on our show, and we're going to start doing that next week. All right, back to our episode. So it's really the details of the deal. Just wanted to kind of talk about that because that was fresh in the news this week. So I wanted to personally understand the breakdown of it and things going on, and how the deal was structured and engineered. thought that you would want to too, just because this is happening right now. So that really concludes our show today. Let me see if there are any questions from the audience. I don't see any. But wanted to break down this Signature Bank, First Republic Bank and the JPMorgan deal and just go through the details of that. I don't see any questions, so we'll call it an early show today. We'll be back next week, Friday, 12 p.m. Eastern Standard Time, another live episode. And we'll be start advertising that. Should have a guest next week. We'll start advertising that. So I hope to see everyone next week. Thank you for your time today, and have a great, fantastic weekend. Cheers.
Understanding the technology that powers the money is essential. Knowing the business drivers that inspire how the money is made is crucial. Bridging the gap between the mind of the technologist and the mind of the business is monumental. That is what TBF is all about. Let's start this never-ending conversation. It's time. Understanding the technology.